how to speculate better in gold, oil, any of the commodities by increasing the asymmetry, giving us more upside and less downside. If that sounds good to you, check out the link in the description below and stay tuned to the end of this video where Patrick and I discuss it further.
The Rebel Capitalist Show, educational series.
It gives me a great deal of pleasure to bring someone back to the Rebel Capitalist Show for the 4th episode in our educational series on options. He's someone I have a tremendous amount of respect for, the co-host of the best macro podcast out there, Macrovoices. His name is Patrick Ceresna, and he is here at the perfect time. With the gold market set to explode, the Fed's taking its balance sheet to infinity and beyond. So today, Patrick is going to show us how to use options to maximize our upside and limit our downside if we want to speculate in gold. So unfortunately, right now, we've got the audio only for this presentation, but you guys are going to absolutely love it nonetheless. So Patrick, I'm going to hand this over to you.
All right. Well, thanks, George, and hello, everyone, and thanks for joining me. So what I wanted to do is talk about how to leverage gold like a pro, even if you hate risk. I love that title. That's what actually the way that the way I kind of put it on. I did this presentation at the VRIC just back in January, and what I meant by it was to follow up. Now, back in October, I was out in San Francisco at the Silver and Gold Summit, where I was on a gold panel. Here, I'll just show you. And by the way, anyone can go onto YouTube and watch it. It was a gold panel, and so many of your good friends to Rebel Capital were on there. So I was on with Grant Williams, Marion Katusa, Brent Johnson, Cal Everett. Many of them are good friends to you on the show. And we were on this panel, and Marion Katusa basically goes and starts asking each one of us on the panel and said, how much is the right allocation to gold in a balanced portfolio, right? And all of the guys, well, 10% of your portfolio should be allocated to gold or something like that. Came to me and I said, I have 100% of the value of my portfolio long gold on top of a number of trades I have there, but I put the trade on in a way that there's absolutely no way I'm going to be down more than 5% on the position. And what's the key to this is this: if you only allocated 10% of the value of your portfolio to gold, but you have a conviction, and you have to have that conviction, that something is terribly wrong, and gold is going to be a huge benefactor and a preserver of wealth, it's going to be the asset to own in this environment. If you only had 10% of your portfolio in gold, and gold doubles in value, while the rest of your equities and everything loses 50% of its value, gold didn't do any hedging. You, like on a 10% allocation of your portfolio to gold, even if it did 100% return and doubled, it barely dented the damage the rest of your portfolio is suffering being exposed to the market. So how do you...
But that's exactly what I would do. That was my mindset and kind of is my mindset. So I'm so excited about this because typically I tell everyone and for myself and my family members, just have 10% of your portfolio in insurance. And for me, that's just physical gold.
But let me ask you something. How many of your listeners, or maybe even you, would actually like to think of it that, well, if gold's going to go up, I want to actually make real money, real return off of gold, right? And so the thing is that, like, I always use that example of, let's say, Bill Gates or Mark Zuckerberg. How did they make all their billions? Did they do it because they diversified their assets, or because they took a shot on their own company and they were all in, fully invested on their companies, and when their company succeeded, they made billions of dollars? They were not diversified. They were concentrated on one idea, and it worked out for them. In the same way, if you have a high conviction that something is going to happen, how do you position yourself to make big money off of it? But more importantly, how do you manage it so that if you're early to the trade or wrong about the trade, it doesn't destroy you?
You know what I like, just before you go on, Patrick, is in my mind, I'm just thinking through this. And what I would really like to do for my portfolio is leave the 10% physical, just because it helps me sleep at night. But then for the 10% of my portfolio that I specifically allocate to speculation, go ahead and speculate on the price of gold through the options.
Right. Well, and so what we did, if you remember in the first episode, what we did together in education, we talked about that GDX and using that long dated leap as a way of participating. And that's something actually I want to go back to at some point. But what I really want to cover here is this idea of actually owning gold, the GLD shares. And how do I manage the risk around it and put on tactical positioning against the physical shares so that I can sleep at night and give myself the opportunity to make really big money. So let's actually go through this and take a look. So I want to talk about the idea of collaring gold. It's this idea of how do you put on a position. Now, collar is this fancy word we use in the options market, but I'm going to try to dispel a lot of these things shortly. But we want to just cover, again, how these options work, and then we'll talk about this collar. Now, one of the most common ways options traders engage the market at the retail level is through a strategy called covered call writing. And it's the idea they physically own shares and they sell call options against them to enhance their income. Very popular. There's a whole series of exchange traded funds that actually even do that systematic option overwriting inherently built into the ETFs. And their whole point is to enhance income for the trade-off of some of the upside potential in an asset. And so the covered call writing is a key component. So what I wanted to talk about is this idea of, well, what if we used some of the income we can generate from option writing to actually buy insurance to remove the downside risk of owning something? And what I want to now talk about is that if I can find a way to create some sort of what's called a hedge wrap, a way of limiting my risk in exchange for some upside potential, I can define my worst case scenario, what my loss can be, and it costs me nothing to do it. And that's the key. It doesn't cost you, like when you buy car insurance on your car, it costs you money out of your pocket. You have to pay. And if you don't crash your car, you're out of luck. But what if we found a way to make enough income to pay for the insurance? And that's where we're going to talk about this strategy of owning a stock and having an insurance hedge wrap built around it. And so what we're going to do is we're going to talk about it, this options collar, of actually creating a call and a put around a long GLD gold position, an SLV silver position, or a gold miner position. And we're going to build this collar around it, and I'll explain it in a moment. But I want to just highlight a great quote from George Soros, which I think is so important. And he says, "It's not whether you're right or wrong that's important, but it's how much you make when you are right and how much you lose when you're wrong." Right? And this is so important. I when I started trading, George, I came in believing that there was some magic way that if I just did everything right, I would find a way to always be right and never wrong. There was this magic sauce out there that if I just learn this and I dedicate myself, there's some magic formula out there to always be right and never wrong. And only as I matured as a trader through 20 years of experience, did I realize that it's actually not about being always right. And this is where you always use the blackjack analogies and things like this. It's actually about managing risk, defining how you're going to manage a situation when things go wrong, and how much do I make when I'm right. It's this word that you've heard me say in the last few episodes, which is asymmetry, which is how do I lose small, win big? Because if I can master that, then my winning percentage is not really important. I could be in fact even wrong more often than I'm right. But long as I'm losing small on all my losses and I win really big when I'm right, then it doesn't matter. right? And so it's something we're going to cover in a future course as well that we'll talk about with many of your listeners. So the thing is, why does asymmetry exist on option collars on gold? And this is amazing because there's amazing opportunity because in the normal stock markets, and I'm about to demonstrate by showing the curvature in the way options are priced, building collars on something like the S&P 500 is actually not asymmetric at all. In fact, it's the opposite because of the fat left tail risk priced into options. But I'll show you actually right now on a screenshot. So we'll actually get to this here. And so what I want to just highlight is start with the GLD, and we're going to just show the chart as to where we were trading here as of yesterday. The GLD was trading at $155.85, right? And that's and there was that blip, that March sell-off that we saw the GLD trade down to like below 140 for a little while for a couple of days, and then rebounded once the Fed started printing QE, and quickly gold rebounded on that. But so I want to talk about, well, what if somebody said, I want to buy gold today? I want to buy gold. Like, I missed the boat. I should have bought a year ago, but I'm starting to realize that this is actually when I should be going heavy into gold. How do we, let's say today, build this kind of a hedge wrap around a purchase of the shares? And I want to emphasize this because a lot of people misinterpret me when they believe that somehow we're going to just use options and not own the shares. We're physically buying the GLD shares the way any investor would be buying the shares. The options are an overlay on top of physical shares we're buying. And so one of the reasons why there's a favorable structure to doing collars on gold is because of the forward price of gold. And that's seen in the contango way that the term structure in gold works, which is, this is from January, but when gold, let's say, was at 1550 on spot.
To be clear for the viewers, the contango is when the current price is less than the future price.
Right. And that's we're seeing super contango in the crude oil markets with the collapse from from all of these different things happening with the coronavirus and the economies being shut down. But for instance, oil tends to trade in backwardation, not in actual which is the opposite. But gold, because it has storage costs, there's security costs, there's all sorts of different things built into it. The future price of gold is, in normal conditions, is always more expensive than the current spot price, because why would I buy the gold today and pay all of the storage and security costs when I can just buy a contract a year from now and have the gold delivered to me at a guaranteed price a year from now and not have to pay all the storage costs, right? And so what happens is the natural contango in gold is that there's always going to have to be in a healthy gold market. You're not going to see backwardation. In theory, if there was a massive shortage of physical gold against futures contracts like this, all that stuff you hear about going on in the COMEX markets and all that, that could arguably create a backwardation scenario. But in a healthy environment, we see this natural term structure. Now, I want to flip to the S&P. And this is fat left tail. Notice that it looks like a check mark. It's like on the left side, the volatility is very, very high. And on the right side of the chart, the volatility is very, very low. Well, this is because of the nature of market crashes. And this was before the market crash, actually. This is the January 15th vol structure when the SPY was at 328. But it does the job because the same kind of skew exists in the market today. The point is that buying insurance for a market crash has a premium. The implied volatilities are more expensive on the left tail, which basically means buying a put option that's, let's say, 10% lower than where the market was trading, was at the time pricing at a 20 vol, but selling a covered call 10% out of the money higher at the market was being priced at a 10% vol. Now, what that basically means in layman's terms is the put option would be almost twice as expensive as the call. right? And that's fat left tail, which is essentially the market is pricing in crash risk and making insurance for a crash more expensive. So the thing though that this does is that if you wanted to do a collar where I sell a covered call 10% out of the money higher to try to pay for insurance 10% lower, I would do it. I wouldn't be able to break even on it because the put insurance will be twice the cost of what I would collect on the call. This is why most of the time doing a collar on the broader stock market does not work. And so this collar strategy is typically not it has a negative carry associated when you're collaring just an S&P trade. But look at the skew on gold. And this is the gold as of yesterday. And notice that buying insurance on the downside of gold is actually cheaper than the premium we're going to receive for selling calls out of the money higher. In fact, we're getting a positive carry, and that allows us to actually build these really amazing skews around gold with collars. And so what's amazing is most people write off these collars because they see on the S&P it doesn't work, and they're completely missing that because of the term structure, which is the forward price of gold is much higher, your break evens are higher, and crash risk to the upside of gold exists, that actually call premium is incredibly rich. And this allows us to actually build some really amazing collars around gold that are not available to us in something like the S&P 500. So let's actually do an example. So let's say the closing price here on the GLD was $156. So now we physically are buying the shares at $156. And what we do is we buy insurance at the $148 strike. So that's the put option on the right-hand side at $7.35.
So we're doing this in addition to buying the physical shares.
We physically buying the shares. And more importantly, George, if you already own the GLD shares and have owned them for months or years, you can implement a collar today. You can there's no rule that you have to buy the shares the same time as you open the collar. You can at any point implement a collar on your existing GLD shares. So all of your listeners that physically have those GLD shares in their portfolio and don't want to sell them, but are worried about the volatility, they are welcome to consider this collar. And this is the prices as of yesterday. I mean, they're going to have changed slightly, but this is very close to where the live markets are today. And so what happens is for every 100 shares, to buy an insurance policy at $148, 5% lower than where gold is trading, right? It's at 156. We're going $8 lower, roughly, rounding roughly 5% lower. It costs me $735 to buy one put option insurance on 100 shares, which basically says no matter what happens, gold can crash to 130, it can crash to 110, doesn't matter. I have locked in a guaranteed sale price of 148. There is not a single way I can lose a penny more than $148. But for that insurance policy, it cost me $735.
And how long does that last?
This is a September 18th of 2020, 165 days. And so we're buying an insurance policy for basically half a year. Right? Now, for us to go more than 10% out of the money on gold up to the 175 strike. So it's 156. So we're going almost $20 higher on the GLD, $19 higher from where it's trading. And a covered call for income will net us $6.10 or about $610 of income. So now what we've actually created we paid $735 out of our pocket, but received $610 back. So our net debit in this scenario is just over $100, $125. So it did cost us. This wasn't zero cost, but it would cost us a very modest amount. $100 on a $15,000 investment. $100 is just a rounding error. Now, what we've created is a scenario where there's no way I can lose more than 5%, but I have well over 10% more on the upside potential So it's asymmetric. My downside risk is much smaller than my upside potential, greater than 2 to 1. Right? And so showing that on a chart, I've created a scenario where at this moment, for almost zero cost, I have 12% upside on gold, but no more than 5% downside risk.
And what I'd be curious is just to do the math on how much that $100 would have been in terms of percentage.
Right. That's like less than 1%, right? Well, let's just round it to 1%. But the thing is that you can actually do it at a zero cost. I just chose the 175 strike, but if you did a 172 strike, let's say $3 lower, that might have netted you more than $7, and it would have actually, let's say, even been a credit, not even a debit. So that is all just on strike price selection. But in this example, I probably should have just made it a wash and made it zero cost. So then
but my point is, even if you're spending,
100.
Yeah, let's say it's 1%, or even you're spending 0.7% of your portfolio to have that asymmetry. It's well worth it.
Right. And so what we have is a scenario where now, if I even had 100% of my entire retirement portfolio all in gold, and everyone's like, ooh, you're taking concentration risk, putting all your eggs in one basket. What if gold collapses, right? Well, no. You know what? I can be 100% in gold, and I know there's no way I'm going to be down more than 5% in the next 6 months on this position. Right? And if that's a risk I'm willing to take, then why should I not be 100% in gold? Right?
Now, what happens if this is probably a stupid question, but what happens if the price goes to 200?
Right. And so this is where we actively manage a position. If the problem we have is that gold is going up too fast and you're making too much money too quickly, a curse I wish upon all your members. It's one of those problems where, yes, you're going to be losing on the covered call above, but that's because you're making so much money on the GLD. Now, what's going to happen in that scenario is we make an adjusting trade. What we do is at that stage, we will close the 175 and reopen a 185 or 195 at a loss, but the loss is offset by the fact that we're making so much money on the actual stock, right? And so it's a trade-off. And so what you're doing is you're kind of giving a little bit of your returns back, but we're doing so with the ability to sleep at night, right? Like that you basically have put all your eggs in one basket, and you know the market can't clobber you. Right. And that's the key element to doing it. And so we're going to show. And so as an example, it's just a good example of we've been managing here. I'll just show the IB account over here. We've been managing a GLD position in this account, the simulated account that I do for Big Picture Trading members. We originally bought 4,700 shares of the GLD at $124 a share. It was a $500,000 position that's up $150,000. Right now we're hedge wrapped between 145 to 165 out till June. And that's where we're currently in that position. And if the problem is that our shares are going up too quickly and we're pressing 165, well, we're going to make an adjusting trade to continue to open the upside of gold to make more gains. Like we're not going to lose our GLD shares. What we may lose is some of the profits that we could have made if we were just in the shares alone. But like I said, this is the trade-off for being 100% concentrated. If you only had a 10% of your portfolio in the GLD, you're making you're a smidget of the profits than if you were 100% in the GLD and you were making that move. And so, yeah, we're making a little bit, we're giving a little bit back against the call, but we're concentrating. We're making the majority of the profits along the way. And so this is the way we approach it, right? And so now I want to go, though, beyond that, the risk management of the asymmetry there, because like I said, like we were talking about, we never said that we will just honor it, and in September, if the GLD is above 175, that we were forced to sell all our shares at 175. No, what we do is we actively manage it. What we'll do is we'll close the 175, open a new 185 or a 200. We're going to make an adjusting trade. Like I said, if the problem is that we're making too much money too quickly, where the GLD is actually going up and doing what we thought, then it's a really great position to be adjusting. I mean, while we're losing on the call, we're making so much on the stock. But when we go beyond the risk management, I want to just highlight that we were bullish this GLD basically for like 3-4 years. We started getting bullish gold back in 2016 at Big Picture Trading. We started taking all sorts of positions. Over the last 3, 4, 5 years, the GLD has had numerous crashes where we saw, anywhere from 14 to 18% drops in the GLD, where it was going from, in this case, from $130 down to $110. Like there were these $24 and $18 drops in the GLD. Imagine somebody who had 100% of their portfolio in the GLD and was not hedged. How would you feel through one of these crashes? It's gut-wrenching, right?
Or even the middle. Look at how volatile the middle is, too.
Oh, absolutely. It's emotionally actually very difficult because you have to keep taking the theme of gold. Gold will go up. I just got to stay with my theme, and I understand that over the long term, gold's going to be fine, and this is just noise. All those things that investors have to do. But for me, when I'm in this gold position with this collar, George, I am cheering gold to crash, because when I'm in the GLD, and let's say we put a floor at 148. If the GLD crashes to $130 a share, I get to sell all my GLD at 148 and buy it all back at 130. I just improved my starting point on my GLD shares by $18 because I'm insured. And so not only do we have a way of managing the upside and built asymmetry, but imagine the emotional feeling of you're 100% fully invested in gold and you're cheering gold to crash. Right? It changes the psychology you feel when you're actually managing your position, because you're not only just cheering it to go up, but you know that you have ways of managing the position when it's not going in your favor.
Yeah, which psychologically, I think would allow people to make better decisions, because I'm guessing that just most human beings, when you're up here, I'm looking at the September of 2016 when we're near 128, and you've got, let's say, 100% of your portfolio in the GLD or in gold, something like that. You're kind of like, oh yeah, I'm never going to sell, I'm never going to sell, I'm never going to sell. I don't care what it does. And it's easy to say when it's at 128. But it's a lot harder to say that when you're down here in December and it's at 108. And I would assume that what most people do is they sell there, and then when it goes back up, so then they buy again, and they just keep losing more and more and more.
But the stock market it gives you a grind, which is it's not just that it went to 108. It went from 122. The next morning you wake up, it's 121. The next morning you wake up, it's at 120. The next morning you wake up, it's at 116. What's happening is every day you wake up and you see you lost more. And then you lost more. And what happens, it just emotionally is this thing like, how low will it go? This gold will never work. All these things that go through your mind.
It goes back up in the interim, Patrick, too, to give you that glimmer of hope.
Yes.
It makes you hold it all the way.
That's just like a bear market rally today in the S&P 500, right, George? It's just going to last long enough to convince everyone that the coronavirus is all over before they pull the rug out from underneath everyone all over again. This is, in fact, what makes a successful trader. George, Big Picture Trading, I've got all these courses, options and technicals and macro and all this stuff. But actually, what makes a successful trader is one's ability to be disciplined disciplined and manage the motions through the cycles, what actually is almost always where the vast majority of retail traders suffer is when they emotionally succumb to greed and fear and all these emotions that make them make bad decisions at the worst possible times. And what I love about these types of option strategies is this is not about us leveraging where we're owning $500,000 of gold with only $50,000 in our account, and we've basically do 10-to-1 leverage, and it's like almost gambling on the market. What we're actually doing is using the options as a risk management tool and an emotion management tool, right? It's about allowing yourself to actually stay disciplined throughout the entire trading process, and that's so important to do, right? It's is to develop that emotional discipline that way. And so this is where we talk about that tactically trading around the positions, right? Which is how do we make these decisions around this? What happens if the GLD goes up? Where do we adjust the call? If the GLD goes down, when do we take advantage and monetize the insurance and improve our cost base by selling GLD at 148 and then let's say buying at 135? This is the art of developing a trading approach that goes around a strategy like this. And what I love about this is that it's about not day trading. It's not about I'm in gold today. It's in a MACD or moving average crossover, and I sell it tomorrow, and it's some technical signals buying and selling in and out. Well, this GLD position, like that GLD position I was showing on the on that demo account over there, we've held that position for years. For years, that position that is a core GLD gold holding in that portfolio, and the options are a risk management tool that we're just managing around a core holding that we're not going to let go. And so you might have a lot of listeners that are like, I don't want to be trading, I want to own investments. Well, we own this as an investment. What we're doing is using the options as a tactical tool for managing risk and for managing the volatility that's associated with that, right, George?
Yeah, I see it just as buying a core position, and you're buying, and then once you've bought it, you just buy an insurance policy on it, and then you just manage the insurance policy.
Yeah,
that's
what we're doing.
Seems pretty simple, yeah.
Yeah, and that's what we're doing. And so there's all sorts of these different ways. So like when we go back to the first lesson we did together, when we talked about using that GDX, the gold miners ETF, and using long dated options as a stock replacement strategy, that is one of the ways to approach it. The second way to approach it is own the GLD or the gold and then trade insurance around the gold positions. These are not right or wrong, good or bad. What it is, George, is that those people that take the time to educate themselves on this stuff,
right.
This is a choice for them. The problem is there's so many, like we did the myths and misconceptions one just an episode ago, and the whole point of it was the fact that so many people stereotype options as risky, and therefore they say, therefore I shouldn't learn it. What they're doing is basically limiting themselves to what few ways of just buy and hold that they can manage their trades, because they're not taking the time to explore what other choices are available to them, right? And the core is that what we want to do, you can be a buy and hold investor, but know your options. Know what you can do when you can do it. Like, for instance, you could have a great gold holding and say, I'm going to learn the options, but I'm just going to hold my gold position. But what if gold jumped to 2,000 and then 2,500 in 3 days? Well, they just had some news event and gold starts ripping higher. And suddenly, deep down in your heart, that gold is probably going to go from 2,500 back down to 2,000. And you're going to see probably a $500 pullback in gold after this is all said and done. But you don't want to sell your long-term gold holding. Well, guess what? Now you have the options collar at your disposal, and you say, I'm going to just lock in this gain. I'm going to build a collar around my core gold position, make sure that these gains I've made, I've locked in without having to sell my shares. Right? But someone who doesn't take the time to educate themselves and know that this is even a choice, it has a simple binary decision. Do I sell it, or do I just hold on and accept the volatility that's about to come at me? Right. And so this is about just taking the time to educate yourself on that. And so this is really where we discussed about this, putting together this great program for everyone. And so
we actually
George
had a lot of demand. I remember I told him to email Sebastian. And Sebastian got a ton of emails. Really excited about it.
Exactly. And so what we're going to do is you asked me to put together a session for your members.
And me.
For your listeners, and you.
More so me, Patrick.
Exactly.
Yeah, I'm selfish here. Don't make me look like the good guy.
So what we did was we talked a lot of theory. We talked a lot of examples and all sorts of different things. But where is it that most people learn? Most people learn through actually seeing it done. And so what we're going to do is we're going to have a live session where me and you are going to throw up some live markets. And we're going to put on all of these trades real time in the live markets. We're going to actually show where is the market trading today. If I had this bias that I'm bullish gold, how do I go long the leaps like we did in the first episode? How do I put on a gold collar on this? How do I put this position on silver? You know, like one of the things we did at Big Picture Trading is when the SLV was trading down at $12 a share, we went and bought leaps, those long dated options to 2022, buying and locking in a $12 purchase price on the SLV. That position's up over 50% on the options since we did that. But you know, this is about how is it that your listeners can take advantage of it, and that's where me and you are going to get on there, and we're going to put on these trades. We're going to explain these trades. What is a call? What is a put? How does it work? How do you execute the trade? How does it look when it's in the account? What should you expect the option to do? All of these things. We're going to spend a couple hours together, and we're going to take a deep dive into this, and I'm so looking forward to it. And so make sure that all of your listeners that want to join us for this one-on-one session where me and you will be going back and forth. And what's beautiful is because you're going to be there learning, you're going to be asking all the questions that all your listeners want to ask, and you're going to be asking, and it's going to be a great learning experience for all of them to watch this. So make sure those of you that want to join George and me on this, come on in there. There's a bonus. And the bonus here, George, is that we started short selling the stock market again at the time of this recording on Tuesday. We basically took all of our profits on our S&P shorts back to a couple weeks ago, and we've been flat and off the market and into this pop on the S&P 500 above 2,700. We began our new short operations on the downside of the market. So during that live session that we're going to do, we'll talk about where and how we're implementing a new S&P short. We're doing all sorts of income strategies. We've got all these gold trades on. So much to cover. So much that I want to show all of your listeners. I'm looking forward to it.
Awesome. Well, we'll put a link in the description below. So if people are interested, they can click on that. Takes them straight to a page with all the details. Again, it's going to be this Friday at 10 a.m. Eastern Time. We're going to keep the price point low, under $100. It's a great opportunity to join Patrick and myself and really learn how to get more asymmetry when you're speculating in gold or any of the commodities.
All right. Well, listen, I'm looking forward to it. We're gonna be online. It's gonna be great. It's gonna be a lot of fun.
Yeah, awesome. All right. Thanks, Patrick.
All right. Thanks, George. Cheers.